Welcome to The Close here on Bloomberg Television. Today, a big focus on the intersection of politics and financial markets. Vice presidential candidate J.D. Vance now speaking at a campaign event in Milwaukee, Wisconsin. Let's take a listen.
Gas and energy and housing were actually affordable to a normal person in this country. And after 4 years of the Biden administration, the basic trappings of a good middle-class life have become less and less attainable. In my home state of Ohio, the average Ohio family is about $10,000 poorer than they were 4 years ago. And of course, Ronald Reagan famously asked in a great debate, I think it was Jimmy Carter, he said, are you better off, he asked the American people in a debate with Jimmy Carter, I should say, are you better off than you were 4 years ago? And I wasn't alive when he asked that question, but I know millions of Ohio families who would answer that question with a resounding no. And if you asked the opposite question, were you better off in 2019 and 2020 than you were in 2016, those same exact families would say, absolutely yes. It is time to go back to the leadership of Donald Trump. It is time to get rid of the corrupt Biden-Harris regime that has broken this country, that has ruined its reputation in the world, and most importantly, has made a basic middle-class life less affordable for our citizens. Let's get rid of him, and let's bring Donald Trump back to the White House. Turns out we have a Secret Service detail. You don't drive anymore. Okay.
All right, we're having a little trouble right now with the audio there, but J.D. Vance, who of course was just tapped by former President Donald Trump to be his running mate on the Republican ticket, his first official comments, at least on the campaign trail, as that presumptive VP nominee as a Republican National Convention continues in Milwaukee. Of course, the big events will be tomorrow night on Thursday, where we get formal speeches from both J.D. Vance as well as the former President Donald Trump. Romaine Bostick here alongside Alex Steele. We are kicking you off to the close here on this Wednesday afternoon. And Alex, a lot to talk about here today with one of the worst days that we've seen for the NASDAQ, tech stocks, chip stocks going back to 2022. And a lot of it has to do with that big interview we had with President Donald Trump.
Yep. And not only that, but you also have the Biden administration potentially reconsidering how foreign chip makers like an ASML can service products in China. And that also hitting some of the chip makers quite hard. Like you mentioned, the NASDAQ's now off almost a whopping 3%. And the SOX index at one point fell the most since 2020.
Yeah, the SOX right now down 6% here. And we should point out, I mean, it's not only are we seeing these declines here, but we're now hitting fresh lows of the day as we get closer to the closing bells. It'll be interesting to see what unfolds over the next hour. Of course, this is something that we knew investors were going to have to grapple with. They just can't sort of have their heads in the clouds. They have to focus on politics and potential policies. Let's try to get some insights here as to how investors handle things with Angela Mwanza, Managing Director, Private Advisor at the Rockefeller Global Family Office. Angela, thanks for being here. As you can see, quite a bit is going on here. The big rally that we've had, taking a bit of a breather here as I think a lot of people really try to assess what policy changes might come in November and more importantly, what that's going to mean for the market. When you look at the pullback and how broad-based this pullback is, does that give you concern here that the rally that we had maybe wasn't as firm as we thought?
It's a very good question, Romaine, and it's something worth really considering. For our clients, we tend to be long-term investors. I work with families and substantial family offices, and for them, they have a multi-generational, if you will, time horizon, which is very helpful in a situation like this because this ends up being a blip on the horizon. With elections coming up and with the volatility that comes with that, there are obviously concerns about what happens in the meantime. I do believe it's a little too early to tell where we're at, and historically, pre-elections, you have a bumpiness in the market. Post-elections, it tends to smooth out and not have as much of an impact, but definitely concerning for some of the mega cap tech names.
This, though, does feel a little bit different than past elections. I mean, there are significant policy differences on most candidates, and more importantly, policy differences that will have huge ramifications for not just our economy, but a lot of countries outside the U.S. as well. Are clients and other folks in your peer group, are they starting to ask these questions yet, or are they still just kind of waiting till we get more clarity as to how November shakes out?
I think the biggest question we're getting is around tariffs and how that's going to impact where we are in the economy. Obviously, where we are today was somewhat balanced. There's some softness in the economy, but earnings growth seems pretty steady, so there's comfort in that. But if we have these tariffs come in, what kind of inflationary pressure will that be for markets here, and how will the Fed have to respond to that? And so I think there's concerns about how that's going to impact the recovery, and that could really kind of derail where we are today.
What it feels like everyone can agree on is that we're going to see larger deficits, and that means maybe a higher back end of the curve. Do you feel like that's a foregone conclusion?
I don't know that it's a foregone conclusion. It's definitely a concern. I feel like the deficit is something everyone's been sweeping under the carpet for a while. I think next year we'll definitely see, and fiscal policy will have a big role in that.
Do you feel then where we are now? I understand you're long-term investors. I understand some of the bigger questions we don't have answers to. We might not for a long time. But still, how much AI versus a small cap do you need to own right now?
With small cap, we've had such a run-up in small cap, which had substantially...
But just 4 days, right? Or just 5 days?
In just like 4 or 5 days, yeah.
I know, but it's not that big.
And they've been substantially underperforming large caps for a while. I feel like it was reactive to the news. I feel that we saw a lot of short covering. And so whether or not this has legs, whether or not this is a time to get very excited about small cap, I think is a little premature. I would like to see some more fundamentals. I would like to see some more earnings growth and quality on those balance sheets before we basically hang up the flag and say we've won on the small cap race. I feel like this is more of a short-term trade right now, and let's wait for the fundamentals.
I am curious about opportunities outside the U.S. I mean, you have a pretty good global perspective here on investment opportunities. There's been a lot of talk about the run-up that we've seen in U.S. assets and the idea that we might have been tapped out, and now folks are looking for value in other countries that may offer a little bit more value. Are you doing that?
We absolutely are, and actually I'm from Zambia, and so copper is the #1 export of Zambia, and when I think of where they're...
language.
Yeah, I love me some copper.
Oh, there we go. And when we think about some of the opportunities abroad, commodities is one of those big areas. Whether you're looking at AI, whether you're looking at decarbonization and electrification, I feel like there's that big wave of commodities, and that's something that's very much played through whether you're looking east or whether you're looking west.
But then, do broad-based tariffs then, under potential President Trump administration, change that calculus?
It may or may not. We'll have, that's a wait and see. It's very interesting because both of these economies are so intertwined. 40% of capital goods imports in the U.S. come from China. That's a huge nut. That's a huge nut for both parties. And so I'm hopeful that there will be enough diplomacy in between, because this does not benefit either side of the coin there.
All right, Angela, going to have to leave it there. Always great insights, and great to have you here at Bloomberg headquarters. Every time we talk to you, it's always on Zoom or some other technology. Angela Mwanza, one of the best in the business, Managing Director and Private Advisor at the Rockefeller Global Family Office, helping us kick you off to the close here on this Wednesday afternoon, I believe. And we are going to go back down to Milwaukee here, where there is a lot of talk about potential political policies here. And we're going to catch up with the CEO of Ripple Labs, who says that this election will be consequential for the crypto industry, particularly as both candidates now stake their positions in this debate.
All right, plus you got Kathy Wood out with another big call on Tesla. You get more on why she sees robo-taxis as the next catalyst for the stock.
And earnings season continues. United Airlines set to report after the bell tonight. Instant analysis as soon as that crosses. Stick with us. This is The Close on Bloomberg. All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start today with Progressive, an upgrade to outperform over at KBW. The analyst saying the slowdown in policies in force should be temporary. And when you factor in growth from premium revenue and moderating loss trends, that should provide a boost to earnings over the next year. The analysts also boosting their price target to $245 from $210. Investors boosting the price up by 5% to a record high on the day. Next up, going in the opposite direction, is Spirit Airlines, a downgrade to sell over at TD Cowen, with the analysts saying with lower income consumers, budget constrained, and oversupply in the leisure sector, there is just too much turbulence to continue recommending the stock. That analyst takes the price target down to $2 a share, investors bidding it down by more than 11%. And finally, Qualcomm, a downgrade to hold at HSBC. The analyst saying without any near-term catalyst and a cooling down of the AI PC hype, there's just a lot less to get excited about. A slight price target increase to 200 from 190, but the analyst remaining cautious and expects Q3 results to be more in line with consensus rather than any type of beat. Those shares have an awful day, down about 9%, and those are some of our top calls. Of course, what's ailing Qualcomm, at least for today, is ailing really the entire chip sector. Red across the screen for the Philadelphia Semiconductor Index, down about 6%, worst day since at least 2022. This on the back of a Bloomberg report about possible trade restrictions against China from the Biden administration, and an interview with former President Donald Trump, who says if he's reelected, you can expect those tariffs on China to ratchet up even further. Stacy Rasgon joining us right now, senior analyst covering U.S. semiconductors over at Berstein Research. And let's talk a little bit here about the potential effect of policy changes, or I guess maybe just keeping current policies in place on this sector. This is a sector that has seen this coming. Has anything really materially changed in your view and how these companies should be looking at the potential for an increase in tariffs or other types of export controls?
Yeah. So the tariffs, not so much, I think, at least not directly. You have to remember the direct trade in semiconductors, raw semiconductors between the U.S. and China is actually not that big. It's only a couple of $1 billion in each direction. In the context of a $500 or $600 billion market, it's not that big. Most semiconductors go between the countries inside other things. The bigger issue, I think, was the export controls. And we did have some potential changes from the Biden administration. They've already, and by the way, I think it impacts not so much the semis, but the semi-cap players, the tool vendors. The U.S. vendors have already been operating under some fairly significant export controls that have prevented their ability to sell leading-edge tools to China. However, there are other non-U.S. companies where the U.S. has been trying to get the same kind of cooperation from them, and they've been a little hesitant. And so there were some news stories that suggested the Biden department was considering applying something called the Foreign Direct Product Rule, right? Which I won't go into what it is, but effectively it would enable the U.S. to effectively implement something akin to those same export controls on the non-U.S. companies. I am a little confused why the U.S. semi-caps are getting nailed on it, if that is what they are getting nailed on today, because to be honest, it doesn't really affect the U.S. Semi-cap players at all. If anything, it levels the playing field. The U.S. guys are already playing with one arm tied behind their back anyways. Would bring the international guys down to the same level. But that's the export control piece of this.
Yeah, I mean, you would expect, a Taiwan Semi or ASML to maybe be affected by this, but we are seeing gains in sort of more domestic-oriented firms like Intel and I think Global Foundries.
Well, so that's a different issue. There was.
Okay.
This was, I think, more the Trump comments on Taiwan.
Okay, go ahead.
And Bloomberg had an interview with him, and frankly, if you read it, I think the initial read was like, he doesn't care as much about protecting Taiwan, which is not exactly what he said. What he kind of said was he didn't want to do it for free, which is not exactly the same thing. But I mean, clearly, I think protecting Taiwan is important. But I think that's why you're seeing most of the semiconductor players out, and you've got Qualcomm and the like that are getting hit because they all rely on Taiwan for manufacturing. And you're seeing the U.S. focused guys, the Intels and the TIs and maybe even the Global Foundries, which have been relatively stronger today in the wake of a weak sector because of. So I think it's more the Trump comments versus the Biden export controls on those.
There's also the narrative, Stacy, that tech has really outperformed. I know that semis have had maybe a rockier time, but tech has outperformed, and we're just reversing that. How much of that do you think is playing in to the sell-off today?
Yeah, so semis in general have had a very strong year, right? And we've seen valuations and everything get very high. The sector itself, even after the pullback today, still trading at more than 30 times forward earnings. And I think relative to the S&P, we're probably at decade-long highs in terms of relative valuations. And so things, people have been playing like it's the AI theme, and people have been playing sort of the bottoming theme with some of the analogs. And I do get a little concerned that maybe, as things recover, we've already started to front run some of that recovery, at least in the valuations. And so things were already slightly stretched. And clearly we've been seeing some rotation out of the space into some other areas, just given the kind of performance we've had. So like everything else kind of piling on top of a space that's a little bit stretched already, I guess I'm not incredibly surprised at what's going on. It was probably bound to happen at some point, especially given earnings is getting ready to kick off very soon.
Well, looking ahead to some of those earnings, particularly out of some of the end users, the corporate end users, whether it's PC makers, phone makers, and whatnot here, is the only story, because when we talk about this big rally we saw in the SOX and all its members, it all seemed to be around that AI narrative. Is there more, though, to that story from a valuation perspective beyond AI?
Yeah, so the valuations are two things. One is some of the AI stocks clearly have run, although if you take the AI stocks out of the SOX index, the semi index, valuations are still very high. And some of that is because we've got a lot of names that have actually been cutting numbers and the stocks didn't go down. And this is not necessarily unusual. Like semiconductor investors do like to buy cuts. They like to buy bottoming things, but usually the stocks go down first. And this time the stocks in many cases didn't actually go down. And so if you've got the stocks being stable or even going up as the numbers are going down, the valuation mathematically goes up. And so that's part of what we're seeing as well.
Hey, Stacy, we appreciate it. Thanks for jumping on with us. Stacy Rasgon joining us from Bernstein. All right, coming up, big banks, it's a big week for them. Regional also results coming out. We discussed the quarter performance plus some election risk with financials with Ken Leon, Research Director over at CFRA Research, joins us with his view. This is The Close on Bloomberg. All right, S&P Financials up 0.7% today. U.S. Bancorp, one of the best performing stocks on the S&P. That's the fundamentals. And then you have the potential exposure to election risk. Bloomberg Intelligence saying financials are one of the sectors most at risk here. Our team writing that if Biden wins, regulators may finalize the last remaining Basel III Accord and incrementally increase stress capital buffers, while a victory by Trump will likely lead to a longer-term decoupling of capital rules with subsequent declines in requirements for the next few years. Ken Leon, Research Director over at CFRA Research, joins us now. That feels very binary for some of these big banks, Ken.
Oh, it does. It's great to be with you. And of course, we've seen rotation in the market today, and financials have been benefiting really for the last few weeks, and they're going lockstep with the S&P 500. I think bank analysts are always toggling between the large global banks and regional banks, and we're seeing good performance from both. But I think overall, when you look out to the next 6 to 12 months, and we'll talk about the election, we certainly favor those banks with a higher weighting to the capital markets and investment banking, and that would be Morgan Stanley and Goldman Sachs. JP Morgan will take along the ride as buys. We see more challenges and perhaps a bit of a slowdown in rate compression in the Bank of America or really even Wells Fargo, and we saw that in the recent results. So those are the fundamentals. I would think I disagree with Bloomberg's conclusion. Basel III endgame is going nowhere. Congress wants this walked back. Jay Powell at the Basel III had a reference to it, but at the end of the day, we're not going to see the risk of 15 to 20% capital build that was the hysteria with Basel III. So I think it's a long way off. We think some implementation maybe next year, but that we're going to take that risk off the table. So we disagree.
Okay, so basically the capital rules, they're going to happen. Don't get too excited about that. But what about the deregulation part of a potential President Trump White House in terms of now is M&A in the space going to become a little easier, particularly among the regionals?
So I also cover the alts industry. Blackstone reports tomorrow, KKR, the top 8. And what we've seen so far, we're kind of from the trough of investment banking, underwriting, and M&A. We're in about the second inning. So we saw good results, high percentage year-over-year gains for all the banks. But then looking ahead, this is important. The financial sponsors, which are the alt industry, have about over $1 trillion of equity investments that have to be monetized. It's very hard for them on new flagship funds to get new money from limited partners if they can't go through this 7-year cycle of selling out these investments. So that's going to be huge momentum, obviously, for them, but it's going to benefit certainly Goldman, Morgan Stanley and other large banks.
Are those large banks, though, are they still taking on that risk, Ken? Or they're willing to, I should say?
You're referring to what specific risk?
With regards to with regards to the private capital deals and the idea of their involvement in that.
Well, they're doing it in two ways, and they have great relationships. First, they play the role as an intermediary or agent to execute those, unless they're going to backstop, any equity IPO, with their balance sheet, but probably less likely. Additionally, if you're listening to David Solomon at Goldman Sachs, they are becoming private equity-like, but not using their balance sheet. So it's very interesting to see that when we look at where are the opportunities, whether it's private credit, in this case, private equity, which helps M&A and equity underwriting for the next 12 months, a lot of good opportunities. But unfortunately, not all banks will benefit from this. And that's why it's our call to pay attention to the capital markets.
I am curious just about the general structure of the traditional banking industry. Coming out of that regional banking crisis last year, there was a lot of talk about consolidation, not just amongst the tiny banks, but even among some of those super regionals. I think that kind of died down, that conversation died down a little bit. But when you talk to executives, they still say that's still in play. Are you seeing that?
We watch it. We watch it closely. And, from our perspective, given that there's additional rules if you're over 100 billion, so it's a delicate dance for executives. There's over 4,000 banks. There's a lot of Congress persons who like having those small banks. They play an important role in the U.S. economy. And certainly if there's M&A, with regional banks, it's interesting. But I think for institutional investors, if you're making allocations in the financial sector and it happens to be part of it banks, you're going to be focusing on the U.S. global banks mostly.
All right, Ken, always great to talk to you. Ken Leon, Research Director over at CFRA Research. Here, a closer look here at the health of the banking sector and how some of the political policies might affect them.
I mean, I feel like this is going to be our life now for the next 6 months, just sort of kind of gaming which the policies will be in the market-moving events. I mean, we didn't learn anything from the last 8 years.
No, we did not. But it's also, too, we talk about kind of this inflection point where so much was changing even prior to this in the industry before,
everything else
election cycle came along and really disrupted. All right, we're going to continue this conversation, go back out to Milwaukee. One industry that could really be affected by the election is the crypto space. Brad Garlinghouse, the CEO of Ripple Labs, he'll be joining us after the break, right here on The Close on Bloomberg. Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. Super hot day in New York, not a hot day in the market. The Nasdaq is still down, up by about 2.5%, with tech continuing to take control to the downside.
Yeah, and this is going to be one of those days with a lot of superlatives here, at least for the main tech index is down the most since late 2022.
Yep, even gold getting hit after hitting a record earlier. So another asset class we're watching that's in the campaign spotlight right now is crypto. Former President Trump, now a crypto champion after calling it a fraud and a disaster waiting to happen. In an interview with Bloomberg Business Week, Trump says if we don't do it, China's going to pick it up. We have a good foundation. It's a baby. It's an infant right now, but I don't want to be responsible for allowing another country to take over this sphere. Joining us now from the Republican National Convention is Brad Garlinghouse, CEO of Ripple Labs. Brad will also attend the DNC next month. Brad, what is your message to the RNC and DNC?
Well, my first message is really that this should have never really become a partisan issue. I think all of us should embrace technical innovation, and these are technologies that truly can transform the cost and efficiency of financial transactions particularly. And so our message is really that we as an industry want to be regulated. We want to have the clarity of that regulation. And it's been refreshing to see the Republican Party kind of lean into that as part of their platform.
You've definitely seen crypto move towards President Trump. Why? What is the Biden administration doing that's so wrong that crypto guys don't like it?
Well, I think the primary thing that has happened is, 5 years ago, I was out publicly saying that there wasn't clarity in the rules and the rules of the road. And 5 years later, after Ripple was sued by the United States SEC, we still don't have clarity in those rules of the road. And so you have in this administration, in Chair Gensler as the chairman of the United States Securities and Exchange Commission, really a fight between the SEC and to some degree the CFTC about who is the regulator of consequence. And Chair Gensler has taken the position that kind of everything is what he calls a digital security or something like that. Judges have ruled against him repeatedly, but this administration has kind of continued that fight against the industry.
What's your conversations that you're having right now with the existing administration? I mean, you referenced some of those lawsuits, and of course, I think it was last July where you at least had that partial victory in that case, and ultimately, more or less, that worked out in your favor, depending on all the legal avenues here. But we talk about an administration that actually seems to now have pulled back. Maybe they got the message, but what conversations are you having with them about the structure of regulations, how they may morph and how they may change going forward?
Yeah, I was actually in Washington, D.C. last Wednesday as part of a crypto roundtable hosted by Rep. Khanna, but attended by Senator Gillibrand as well as Anita Dunn from the White House. And it was, I think, the Democrats realizing that they've kind of gotten behind where the Republican Party and the Republican platform has been as it relates to crypto. And I think they were there listening to the industry. Mark Cuban was one of the hosts of that event also. And so I think it was refreshing to start to have that conversation. But as you referenced, this is almost exactly a one-year anniversary of the court case where Ripple was sued by the government. And look, the one thing that the SEC was arguing most vociferously was this idea that XRP, the digital asset that Ripple uses in our technology, was a security. And that was really what they cared about. And what the judge ruled is that XRP is not a security. And that's really been a formative case for the industry. So we're going to continue really clamoring and trying to champion the clarity of regulation. And I'm hopeful that as we see a changing of the guard, we'll see that.
Sorry, just to clarify, though, I mean, was the ruling, though, it did make a distinction between institutional investors and retail investors, did it not?
What it said actually is that just like if you package up real estate or you package up even pork bellies, if you put those into an investment contract, the investment contract is a security.
Gotcha.
But the ruling was very clear that no matter what, XRP in and of itself is not a security.
Brad, do you agree then with, okay, so the reason why, in part, that President Trump is pro-crypto is because he doesn't want China to be more crypto than the U.S. Is that actually like a material risk that China would surpass the U.S. in terms of its crypto innovation?
Well, I can't speak to China specifically, but what we are seeing is whether it's the UK, Japan, Singapore, I mean, even the European Union, more than 24 countries have come together to create a framework to provide crypto regulation. They call it MiCA. And what's frustrating as a U.S. company and someone who grew up here in the Midwest, it's frustrating that we as a country can't get that rules, the framework in place. And instead, we have this interminable litigation coming from the SEC that really isn't solving the problem. Well, we went to court and spent over $150 million in 3 years of our time arguing that in the court and prevailed. We can't do that with every single token. And so we have been advocating, and there is legislative momentum, both on the Democratic and Republican side of the House. Something passed the House just recently called the FIT 21 Act. The Senate is considering various bills. And certainly with the choice of J.D. Vance as a vice presidential candidate, he personally has put forth language, a draft language for a bill that the Senate may or may not consider.
So it's less about the daylight between the regulation of the two parties, and it's more just about Gary Gensler.
Well, certainly Gary Gensler, in my judgment, has been at war with crypto. That is for certain. But it's also, I think, a tone from the overall Biden administration. The OCC certainly has been anti-crypto. You're seeing other elements of the banking industry really take a kind of an anti-crypto point of view, which hasn't, I don't think, served us well. And to Romaine's question earlier, I think, we as a country have benefited immensely from being the heart and center of the internet. The internet really grew up here in part because we had clear regulatory dynamics in the United States passed in the late 90s. That allowed entrepreneurs to build, that allowed capital to flow in. And I think we've been seeking that as other countries around the world have leaned into that and provided that clarity. And you're seeing entrepreneurs and capital in this industry flow into other countries instead of the United States.
I am curious, though, Brad, too, when we talk about the regulatory aspects of it, and I understand the policy platform that Trump and, to a certain extent, the J.D. Vance has started to articulate since he got named as VP candidate. But we also know that a lot of the objections to, let's just say, the growth of the crypto space was not just coming from the White House directly. There were concerns raised by the Fed. There were concerns raised by the Treasury. Agencies that, to a certain extent, will have a certain degree of autonomy from anything that comes out of the White House, no matter who is sitting there in the Oval Office.
Yeah, I agree wholeheartedly with that. I think that, look, what we are seeing and what we are seeking is clear rules of the road. The vast majority of people I know in the crypto industry are good actors who want to follow the rules. We've been asking for clear rules. And I think, as Alex described earlier, in Chair Gensler, instead of saying, let's codify that, let's sit down, they keep hiring more lawyers to bring more lawsuits. And again, it's just a silly way to approach regulation. Through enforcement is not the best way to approach this problem. And that's why we've been working with people on Capitol Hill. And again, on both sides of the aisle. It just happens to be this became partisan for maybe good and bad reasons, and you're seeing the Republicans kind of lean into it more so than the Democrats.
We only have about 30 seconds left, Brad, but I am curious here about your relationship with the SEC. Are you in settlement talks at all with the agency right now?
I can't comment on that specifically. Suffice it to say that the ruling has been clear from the judge. There's one final piece, as you referenced, about these investment contracts that are sold to institutions. We expect resolution very soon, but can't predict exactly when the judge will rule there.
All right, Brad, thank you for taking time for us. Brad Garlinghouse, he's the CEO of the crypto company Ripple Labs out there at the RNC convention in Milwaukee, Wisconsin. And as you pointed out, Alex, he also says he plans to attend the DNC convention as well to make his case.
You know who also wanted regulation for crypto?
Who's that?
Sam Bankman-Fried.
Oh, yeah. What's he up to these days?
There was that. I don't think he's doing too well. I'm just saying, like, that they all say that. They all put that out there. Anyway, quite interesting how that's shaping out.
Well, it's interesting, too, that this has actually now become a legitimate campaign issue here, too. Obviously, the Trump administration, the Trump campaign trying to use this as a bit of a wedge issue for voters. We'll see if it resonates here. In the meantime, we do want to go back to some of the individual stocks in the market and take a closer look at Tesla. Kathy Wood weighing in again here, making a big call on Tesla's robo-taxi potential. We're going to break down her view in today's Stock of the Hour. That's coming up next. This is The Close on Bloomberg. All right, time now for our Stock of the Hour. A closer look at shares of Tesla, down about 3.5% right now, despite the fact that famed investor Kathy Wood is actually doubling down here on her bullishness, her long-term bullishness on the EV maker, specifically when it comes to it forming an autonomous taxi platform that she says would be the catalyst for a roughly tenfold increase in its share price. Bloomberg's Abigail Doolittle joining us right now for a little bit more. Of course, Kathy Wood is known for some very lofty predictions here, but talk to us about why investors would be excited about this if this were to become true.
Well, I think we have to start off with what strikes me as the most interesting and important point, and that is Elon Musk is the king of AI. People don't realize it, but he is building an ecosystem that is comprised of these robo-taxis. It's comprised of all the satellites in the skies.
Does Jensen Huang know that Elon Musk took his crown?
So he's hardware.
Oh, okay.
So at some point down the future, it's going to be commoditized. Elon Musk is going to be the king of all of these shiny AI things that we use in the world, and especially if we do use robo-taxis at some point. And otherwise, it just doesn't make sense her saying that this is going to be an $8 trillion company, because if we think about the robo-taxi itself, it may hit the road in 2028. At that point, it could be $50 million. 2032, maybe $1.5 billion, maybe meaningfully profitable at the end of the 2030s. To say you're going to get a 10 times fold increase off of that alone, it just doesn't make sense. But this is also a battery on wheels. It's actually distributed power. It can be driven to places. Utilities might rent it. And then the other thing is that I learned today, I know, the look of fascination on your face is the look of fascination.
Is that fascination or confusion on my face right now?
Fascination, I think, which is what I had a really interesting conversation with one of our analysts analyst here, Stephen Tan, and he was talking about everything that Elon Musk is doing with all these different companies, and it's just so compelling. And another point, he was the founder of OpenAI. People don't often think about that. They think about it with Sam Altman, but the Tesla computer itself is as strong as these computers, and they're hooking them up, and there's computer power. So my point here is this robo-taxi is not just an automated car that might take you and I, from point A to point B, or something along those lines. It's so much more, and I think that that's what her big bet is.
Well, and that makes sense for Cathie Wood, who, we talk about her as if she's a day-to-day investor, but she's not. I mean, she's investing for these long-term themes. Moonshots. Well, and this would make sense, and this would be a moonshot.
Yes.
And basically what you're describing is AI disseminated into stuff we use every day, not the iPhone or the iPad, but something that we use as a functionality.
Yes, and that's, I forget who joined Bloomberg Television last week, The Big Short, Steve Eisman. He was saying that it's going to be in everything. In 2 to 3 years, AI is going to be in absolutely everything. I really don't use it to my knowledge at this time, but the bet is that it's going to become so, synonymous with everything that we do. Relative to...
We got to leave it there. But thank you for that. We really appreciate that. She's getting excited about that. But Tesla shares down by about 3.5%. All right, coming up, we're going to continue to count you down to the closing bells. Mandy Xu, head of derivatives market intelligence over at CBOE, will be joining us. This is Bloomberg.
Obviously, where we are today was somewhat balanced. There's some softness in the economy, but earnings growth seems pretty steady, so there's comfort in that. But if we have these tariffs come in, what kind of inflationary pressure will that be for markets here, and how will the Fed have to respond to that? And so I think there's concerns about how that's going to impact the recovery, and that could really kind of derail where we are today.
Angela Mwanza there, Managing Director and Private Advisor at the Rockefeller Global Family Office, helping us kick off to the close just about an hour ago, Alex, on a day where we're seeing a pretty massive sell-off, at least for most of the major indices, sans the Dow Jones Industrial Average for some reason. But the big drawdown that we're seeing in tech stocks and, more importantly, chip stocks, quite remarkable.
Yeah, it's United Health, I think, for the Dow. You're looking at the S&P down over 1%, the NASDAQ 100 the lowest, selling off the most in over 2 years. Intel is a different story, right? So it's interesting to see if you kind of parse through some of the chip guys, the ones that are really selling off and the ones that are not. And also the Russell outperforming. I appreciate it's down almost 1%, but that's still a lot better than the NASDAQ. So you could still make an argument that the rotation trade is still there. Yeah,
we're going to talk a little bit about that rotation trade with our next guest, Mandy Xu, joining us right now, head of derivatives market intelligence over at the CBOE, helping us count down to the closing bells. And Mandy, before we get to the rotation, small cap rotation, I have to ask you about the moves today. Most of this seems to be predicated on various political comments, both from the Biden administration as well as from Trump in that interview with Bloomberg Business Week. A lot of folks really rattled about the political implications of public policy on these stocks. I know that's normally not your wheelhouse here, but when you look at the price action today, how reflective is it?
I think it ties into a theme that we've actually been seeing since the start of the year, which is even while overall levels of index volatility is very muted, we're seeing big moves at the stock level. And I think part of that is driven by fiscal policy, expectations of fiscal policy changes, how that's going to impact different sectors differently. So you're getting outsized moves, right? So if you look at today, NASDAQ is down a lot, the market's down a lot, but it's really dragged down by these select few stocks, right? So it's still very much an idiosyncratically driven, fundamentally driven sell-off rather than a macro, everything sells off together type of move.
Based on your own knowledge of history, that's a good thing, relatively speaking?
It shows that the risk is still very much about fundamentals, about earnings. It's about stock selection rather than recession fears, for example. So one of the things that we've been highlighting is overall levels of correlation in the market historically low, right? Not just backward-looking measures, but forward-looking measures. People expect us to be in the stock market, a stock pickers market for the foreseeable future, where it's going to be really come down to earnings and to these fiscal policies and monetary policy changes and how that's going to impact different stocks.
Scott Rubner over at Goldman Sachs, he's a strategist over there, has been pounding the drum on July 17th is the day where after this, the market's going to sell off and be kind of neutral going back. That's when the returns on the equity benchmark are done. Are you seeing that reflected in positioning in the options market?
Not quite. So, I mean, first of all, if you can look at the VIX futures curve or any kind of volatility futures curve, you don't really see anything that's dramatically different pre or post that date. But overall, I would say actually the theme in the options market tends to be actually quite constructive still, where we're seeing a lot of still upside chasing, particularly in small caps, you know, the rotation trade that you alluded to earlier. So I don't see anything in the options market that would kind of suggest to me that investors are very bearish in the near term. One thing that is worth highlighting, but it's a trend that we've seen kind of all year, is we're seeing outsized VIX options buying, so VIX call buying. But that, I think, is more of a tail hedge rather than like a core scenario or a core outlook where people are expecting a sell-off.
Like just in case they're upside.
Exactly.
Let's get into that. What about individual stocks around earnings? Are we seeing a lot of options activity there?
Yes, so I alluded to earlier, but we are seeing very outsized volatility being priced in at the single stock level for earnings. One of the ways you can look at it is, for example, our S&P 500 dispersion index, which measures kind of the volatility at the single stock level. That's at a one-year high. And if you back out like the volatility at the single stock level versus the index, that spread is at an all-time high right now. So if you look at the VIX, it's misleading in the sense that you're saying, you might think there's no volatility in the market, but at least underneath the index surface, there's plenty of volatility, and that is being reflected in single stock options.
But going back, but sticking with that single stock narrative too, we talk about that small cap rotation. A lot of that does seem to sort of be reflective of what you're talking about here. Even on a day like today where everything's down, you're still seeing massive outperformance relative to the broader market.
Yeah, exactly. So in the options market, in small caps in particular, we're seeing a huge bid to Russell 2000 index volatility. That spread versus the S&P is at a one-year high. We're seeing actually inversion and skew in Russell 2000, meaning actually calls are trading at a premium right now to puts, which is extremely rare at the index level. Last time we saw it was actually Q4 December, but before that, it was almost 20 years ago. So that kind of gives you a sense of how rare it is. Now, part of it, I think, why we're seeing this options activity is that, we've been here before, right? People got really bulled up in small caps Q4 last year when rates came down. Didn't end up actually working out. So I think this time around, I think you're seeing that options activity as a limited risk way of kind of getting into that rotation without shifting all of your portfolios around.
What I'm so interested in, too, is that the VIX curve, you see the normal jump around the election, but it hasn't increased since Saturday. And I don't know what my takeaway is from that.
It hasn't increased and hasn't decreased. It's been pretty sticky all year at around about 2.5 vol points, meaning the VIX October future trading about 2.5 points over the September, kind of embedding a little bit of an election risk premium. I think part of it is just we're still so far out, and people remember, like, for example, 2016 election, there were points during that election cycle where Trump was down double digits, everyone had written him off, and of course, come November, the result was very different, right? So I think, part of the reason why the premium hasn't really changed is that despite what the polling may show right now, there's still a long ways to go before election day, and a lot can change in between.
Does that also mean, too, that if the VIX curve hasn't come down, does that also mean that we're not sort of baking in 100% a Trump win? Because in theory, as you were sort of mentioning, if you're taking out, you're saying, okay, President Trump's going to win, no questions asked, then the volatility should come down because we have certainty, right?
Right, exactly. So people still pricing in quite a bit of uncertainty as regard to the election outcome. And also part of it, I think, is the last two elections, I think it's been really interesting that even if you told investors who was going to win, people probably still would have gotten the market reaction wrong. So I think here there's a little bit of humility on the part of, I think, markets and investors and traders saying that, like, yes, things may look one way now, but really we don't know how it's going to play out.
All right, Mandy, great stuff. Mandy Xu, head of derivatives market intelligence over at CBOE, counting you down to the closing bells with about 3 minutes to go here. We should just point out the Philadelphia Semiconductor Index hitting fresh lows here on the day, now having its worst day since 2020. But to Mandy's point here about how idiosyncratic this sell-off is, you got 5 of the 11 S&P sectors in the green.
Right, exactly. Like, it really is truly a big tech story. And I have to wonder, too, if we didn't get the headlines overnight about sort of more export curbs or the interview with President Trump, would we have seen a version of this anyway, like the rotation trade, sell tech?
I don't know. Well, it's a good point. I don't know the answer to that. But the fact that it did all come on the same day certainly had an effect. But you're right. Some of this might have been brewing even before we got to today as we count it down to the closing bells. You want to stick with us because we're going to have full market coverage of a historic day right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele, here to help you take you through the closing bells. It's our global simulcast. It starts right now. Scarlett Fu in the TV studio, Carol Masser and Tim Stenovic in the radio booth. Welcome to our audiences across all of our Bloomberg platforms. On a pretty historic day here, Carol Masser, a huge sell-off in tech with the Philadelphia Semiconductor Index hitting fresh lows on the day, down 7%. Worst day since the onset of the pandemic.
Really substantial, right? It's something that we've been talking about. I know you guys have as well. A couple different reasons, whether, more restrictions potentially coming out of the Biden administration in terms of tech sales related in the semi area to China, but also, thinking about the Bloomberg Businessweek cover story where Donald Trump was asked about, protecting of Taiwan, of course, home to TSMC, and not necessarily saying that he would run to Taiwan's aid, which makes you wonder about, okay, what does that mean for the global supply chain in the semiconductor world?
And it's not just semiconductor stocks today. We got Apple shares down 2.5%, Meta Platforms down 5.6%. We got Amazon down 2.6%, Microsoft down 1.3%. The Mag 7, big tech, the stocks, you name it, it's selling off.
Remember when we ask everyone what they think about the election and how that's going to affect markets? Everyone says, no, it's too early to talk about that. It won't happen until we get closer to November. It's happening.
Well, that was also sort of my point earlier, is that were we already sort of set up for something along these lines? I was saying that Scott Rubner at Goldman says that today usually marks a turning point for returns on the equity benchmark. This is going to data all the way back from 1928.
Yeah, well, it gets to the point, too. I think to Scarlett's point, too, elections do matter, not always in the most dramatic way, but they certainly do. An interesting day. And just look at that screen here, because this really tells a big part of the story. You have a Dow Jones Industrial Average up 240 points, up 0.6%, really on the back of just a couple of names. That's a record high. But let's flip now to the other stocks here on the screen. You have an S&P 500 down almost 80 points, more than 1% here on the day. A NASDAQ composite down more than 500 points, or about 3% on the day. And you have a Russell 2000 also down about 1% here on the day. And there's some pretty big moves to the downside. We talk about the Philadelphia Semiconductor Index down the most since 2020, Carol. And, of course, that NASDAQ 100 down the most since 2022.
All right, let's get to it because some earnings crossing. United Airlines crossing. Here's the red sticky, as we call it here at Bloomberg. Second quarter adjusted EPS, folks. It's a big beat. $4.14 a share. That compares with a street estimate of $3.93 a share. So you're talking about 21 cents to the upside. Also looking at passenger revenue, $13.68 billion. That's a little light. That's for the second quarter. $13.74 billion was the street estimate. Also looking at second quarter operating revenue. That's coming in just a hair light, $15 billion, Alex. That compares with an estimate of $15.04 billion. Stocks down about 1.8% here in the aftermarket.
Yeah, let's get to some of the details here. So they say in the press release that the company sees mid-August now as the inflection point when industry-wide oversupply eases and United is positioned to benefit. Basically, overcapacity, that weighs on fares, that weighs on revenue, and they see that mid-August is that inflection point. But that does imply, though, that that top line stays strong and that travel does stay strong. And you're taking a look at the stock down by about 2.6%. Yeah. They're also talking about premium revenue, basic economy revenue, and market share shift, all among the domestic road warriors, all that gaining momentum in the second quarter for them.
I am curious, though, too, when they talk about, they're basically saying they're going to pull capacity in order to deal with this here, but there are still some other costs that they have to contend with that they mentioned in the release here that really aren't going to be solved necessarily by taking planes out of service. And I do wonder how you right-size this ship if there is legitimately a softening in demand for air travel.
Yeah, it's interesting because, not apples to apples, but Spirit Airlines reported earlier today, and they said that that they actually had total revenue for the second quarter they thought would be lower than they expected, but it wasn't because of capacity issues. It wasn't because of ticket revenue. It was because of non-ticket revenue. United coming out and saying that revenue diversity is helping them and that they have they've been preparing for this idea that Alex was talking about that inflection point being when there's an industry-wide domestic capacity would just, they're well positioned for that. they're ready for that.
Yeah, not to mention the fact that they, of course, benefit from strong travel demand in Europe and in Asia, which kind of sets it apart from some of the other carriers. Let's just go to IMAP for a moment, because even as we look at the market and the sell-off, especially in the tech space, whether you're looking at chip makers or software companies, overall, you have more advancers than decliners when you look at it on a sector basis. Consumer staples, energy up by at least 1%. Financials also higher by 0.9%, but it's the heaviest weighted sectors, tech, communication services, and consumer discretionary, that are really weighing on the S&P 500. They're each down by at least 1.8%.
All right, that's a sector look in terms of winners and losers here. Let's get to some of the individual gains, if I may, in terms of the trade. And keep in mind that about half the names in the S&P 500 actually did post gains today. Intel at its highs today, despite the sell-off in the semiconductor index. You did see Intel at one point up 8% in today's session, just eking out a little bit of a gain, 0.33%. What's interesting is Intel and Global Foundries were two names in the semiconductor sector that we did see actually rallying in today's session. Basically, investors doing some speculation that the two could benefit potentially from some fresh policies under either a Biden or Trump administration. The other thinking was that business recover story where Donald Trump was saying, wait, maybe we will come to Taiwan's aid should China put intense pressure or amp its pressure up on Taiwan. Specifically, Taiwan, of course, home to TSMC, a foundry. Intel increasing its foundry build-out, certainly here in the United States. Same thing for Global Foundries. So Intel was up a little bit in today's session. Global Foundries was up, finishing the day with about a gain of 7%. So investors may be thinking, okay, just a lot going on in the semi space, and maybe these are two names that ultimately benefit. Got to mention Roche Holding, ADRs that trade here in the United States, up about 7.5%, pretty much finishing near its highs of the session. The company out, experimental weight loss pills showed meaningful weight reduction in an early stage study among obesity patients. So this company could certainly be a challenger to the likes of Eli Lilly and Novo, who definitely did see some pressure in today's session. And just real quickly, J&J also out with the earnings today, and Johnson & Johnson up 3.7%, outperformance there. Second quarter profit beating Wall Street projections. Strong pharma sales. Company cut its full year forecast, though, to account for a spate of recent acquisitions. So you did see some names actually pop in today's trade.
Okay, some names that didn't pop today were certainly semiconductors. Worth revisiting what happened on the stocks today after that broad sell-off in chip companies. Down 6.8%, its worst day since March of 2020. Interestingly enough, only trading at levels last seen just about 3 weeks ago. The concern, again, is that tighter U.S. restrictions on chip sales to China and the Biden administration telling allies that it's considering using the most severe trade restrictions available if companies such as Tokyo Electron and ASML continue giving China access to advanced semi technology. We saw those stocks sell off overseas. Here in the U.S., we saw NVIDIA, AMD, and Broadcom fall as well. In addition to that, it wasn't just chip stocks that fell. We also saw mega cap tech under pressure. Meta and Alphabet fell today. Also, shares of Apple under pressure, falling 2.5%. And I mentioned Spirit Airlines in the context of talking about United just a little earlier. Spirit shares fell after the company estimated that total revenue for second quarter would be lower than previously expected, mostly due to non-ticket revenue. So what we're talking about is the add-ons that it charges separately for assigned seats, printed boarding passes, an in-flight bottle of water, heavy bags. That's where the shortfall is coming from, not necessarily lower fares, as other airlines have talked about, Alex.
Yep, so good for consumers, not as good for the company. Let's get back to United here, because it's also dragging down other airlines as well. So that second quarter adjusted earnings did wind up beating estimates, but it's the third quarter adjusted earnings coming in at the high end at $3.25. Even that winds up missing estimates. They do talk about, though, how they grew basic economy up 38% and premium up 8.5%, and they're continuing to reduce their planned domestic capacity by about 3 points in the fourth quarter. So continuing that theme of managing what they can manage in terms of capacity as the overall top lines may or may not continue to be strong.
It gets to also the question of discounts. And I think when we talk about what was going on with Spirit and the idea that a lot of customers are finding ways to trim their own costs, so maybe not buying the tickets but not paying for those extra add-ons like Tim was talking about. And we kind of forget when we talk about Delta, United, these big carriers, yeah, sure, they have a front of the plane there that maybe has a premium price attached to it. But in the back of that plane, well, they still have a lot of economy and budget consumers who are much more cost conscious.
Even as it gave an outlook for this quarter that does miss the average analyst estimate, it did not provide an outlook for third quarter revenue, which is interesting because, Alex, as you mentioned earlier, it sees mid-August as this inflection point. So if fare cuts could start fading after that point, maybe there's room to surprise when it comes to revenue, and perhaps that's why it didn't give specific numbers for the top line for this quarter.
But again, United down about 4%. I do think, in the press release, CEO Scott Kirby of United saying, again, United has been long been preparing for the moment when an industry-wide domestic capacity would adjust. It's now clear that inflection point is just 30 days away. I mean, giving us a little bit of a timeline. So what that means, I'm looking at Delta, guys, down about 0.8%. JetBlue looks a little change in the after hours, and you've got Southwest down about 0.4% here.
Okay, so we'll hear from some more companies in the coming days too. We haven't heard from all the airlines yet.
Yeah, we'll see whether or not this carries over.
I love your optimism, too.
Yeah, I know. I'm always looking forward to things. Glasses half full.
All right, guys, that's going to do it for our cross-platform coverage of the market close, of course, on Bloomberg TV, radio, Bloomberg Originals on YouTube. Alex Steele, you are heading out too, but no worries. She's going to be back tomorrow, same time, same place.
All right, stick with us. Bloomberg Television continues with more coverage of what's been going on with United Airlines. Those earnings just out. Also expecting earnings in just a bit from Discover Financial as well as Alcoa. Stick with us. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. What a day it was in the markets here. We had some interesting developments overnight when it comes to public policy involving the U.S. and its relationship with China. That put a big sell-off underworks here, primarily in the tech space, primarily in the chip space, with the Philadelphia Semiconductor Index down 7% on the day. That was the worst one-day gain for the stocks going back to the onset of the pandemic back, Scarlett, in March of 2020. But we should point out, 30 members in that Philadelphia Semiconductor Index, and for some reason, 2 of them did not sell off at all.
Yeah, that's right. Intel is notably one of them, and Global Foundries, the ticker there is GFS, also defined the overall decline in chip stocks. So both of these names seen as potentially benefiting if the White House does move forward with more import restrictions on advanced semiconductor technology. Specifically, GFS is based in upstate New York, and you have Intel, which is based in Silicon Valley. Both of those companies received awards as part of the CHIPS Act because of their domestic manufacturing operations. So investors extrapolating the White House's considerations and thinking that these two could benefit. Meantime, you have Five Below losing a quarter of its value today. That is now the lowest since May of 2020 for the company. The discount retailer cut its second quarter earnings per share guidance and announced that its CEO, Joel Anderson, would step down. At least 7 analysts downgraded the stock in the wake of that announcement. But our top story this hour is really a deep dive into what a Trump 2.0 administration would mean for investors. According to the former president and current Republican nominee, Trumponomics is shorthand for low interest rates and taxes. We know this. That is not new. But this time around, he plans to implement them a lot faster. So later this hour, we're going to discuss the costs, political and economic, inherent perhaps in that approach.
All right, Scarlett, we have a lot of earnings we have to get to before we get to that. Alcoa earnings crossing the wire just a little while ago here. At least on some of the main metrics, it does appear that the aluminum giant did beat on those estimates. Adjusted EPS coming in at about 16 cents a share. That's an improvement from a loss that it had in the year ago period. As far as revenue goes, that's also coming in at about $2.91 billion, slightly above street estimates, and the company guiding for the full year, saying the shipments will be about 2.5 million to 2.6 million metric tons, and production in the 2.2 to 2.3 million range. The shares a modest bid, and after hours trading up about 2%. Now to the flip side, right now we're taking a look at United Airlines. Those shares down about 3.5% in after hours trading on the back of an earnings report where the company said its profit in the current quarter will fall short of Wall Street expectations as it slashes ticket prices to try to keep those seats filled. George Ferguson joining us right now, who covers the airline sector for us over at Bloomberg Intelligence. What exactly is going on here, George? I think we heard a couple of weeks ago from another airline. They also talked about heavy discounting. Is this thing also ailing United?
Yeah, so as we look at United's earnings, I think, expenses came in largely where we would have expected, but revenue is it's in line, but revenue's falling, right? It's falling in their most important markets, the domestic market. I would say they're doing a bit better than Delta. Yields, which is the price paid per mile flown, down 1%. Domestic market, Delta was down 2%. Yields going to Europe, which we kind of were watching that summer vacation season that goes across the Europe, very profitable. Usually for the airlines, up 5.4% into Europe. That's better than what Delta reported. And I'd say the Latin America market, which is another very important market, yields are down 7% going to that market. Delta saw something like 14%. So we're continuing to see yields fall. It's not as bad at United as it was at Delta, but the trend continues into 3Q, and that'll be the challenge is as revenue comes down here, expenses are harder to shed. It'll be hard to keep profitability up.
Does reducing capacity, as they state in this press release, is that going to help?
Yeah, all capacity reductions help. Summer is super important for profitability, so they have to get it done, I think, here in summer season to keep profits up. It's hard usually because you have a lot of schedule out there already, but that's the way forward for the airline industry right now is cutting capacity so they can shore up fares.
George, I find it really interesting that United identified mid-August as this inflection point when industry-wide oversupply eases and it's best positioned to benefit. This sounds like a capacity problem that's been resolved or addressed. But what about the demand side? What puts United in a perhaps better position than some of its peers when it comes to demand?
Yeah, so I think United's international exposure, it's by far the biggest international of the U.S. airlines. I think a lot of that vacation demand is insensitive or less, nothing's insensitive, but less sensitive to price. Families usually have those bookings put in place even at the beginning of the summer, so it's longer term. They've got longer term visibility on it. It's longer term bookings. But, I'd say we heard similar things about Delta. Delta said that they thought capacity was going to come down strongly in the third quarter and things ought to be much better. At Bloomberg Intelligence, we have a report out on our airlines dashboard. Yeah. When we looked at it, the last we looked, we still saw capacity growth well above GDP growth. Mm-hmm. And we think that means softness. So we'll go back and take a look at those schedules again and see how it's developing. But I don't know that they have that much visibility. So, remains to be seen, I think.
Got it. George, really appreciate your joining us. George Ferguson of Bloomberg Intelligence.
Thank you.
Now, as airlines continue to report their earnings, let's take a check on the state of the luxury travel industry with Alan Fuerstman. He is founder and CEO of Montage International. It's a luxury hospitality management company based in Irvine, California. Great to speak with you, Alan. Thank you so much.
Great to be here.
So you just heard George talk about the airlines a little bit. I'm wondering what kind of correlations you tend to see between what the financials for airlines looks like and how that trickles down or doesn't in your industry.
Well, we've seen great strength this summer. Especially in the luxury segment, it's not surprising. Our resort destinations are very much in demand, and we've seen terrific growth year over year. So we're really quite pleased with the direction we've been going.
When we look at the luxury space, the high-end space, there are some signs that perhaps there's softening ahead. Sales of Swiss watches, for instance, weakening a little bit. There's weakness certainly in China as well. Are these perhaps precursors of something broader, or do you look at them as a one-off when you look at what's going on in the luxury space?
The best leading indicator for us is our group booking pace. How's corporate America booking into the fourth quarter and early into next year? And we're seeing, as we look to next year, stronger numbers than we saw coming into this year. So we're pretty confident that we'll be able to continue to see the kind of growth and steady business that we've enjoyed.
I'm sorry, so make that link for me. When you're looking at corporate travel here, how is that translating to the non-corporate customers that will be using your property?
Well, the vacation segment, the summertime is pretty well baked. It's plans been made, and there's still some short term that tops off. But the longer out bookings is done on the group segment because they typically have to be booked anywhere from 3 months to 2 years out to plan the meetings, the events, and all that goes with it. So when the economy tightens and groups pull back from those types of meetings, then we would experience it. We're not experiencing it right now, so we're relatively optimistic looking to the next few quarters and beyond.
If we do get to that point where you start to see signs that that might be happening, is there a way to blunt that impact? Like, what changes do you make at the company?
Well, then we try and shift away from the group segment of business and take on more individuals. So it might be through packaging and special offers and the different market segments you would attract, absent of the group. But the group's an important segment, so that's part of what we need to look at. But it's the leading indicator of what we see for 2025.
Let's continue to connect the macro with what you see on your end. We know inflation is stabilizing. It's certainly coming down closer to the Federal Reserve's 2% target. What are you seeing when it comes to price increases, especially when it comes to wages and it comes to some of your overhead?
So we've had, as I'm sure you're aware, huge increases in cost of operating the business, but you've also seen increases in rates to offset the kind of expenses that the hotel industry has been hit with. I think as the costs stabilize, I think you're going to see less rate increases that we've been able to offset. We won't need to offset that as much, so you'll see a more traditional steady rate increase, a much lower percentage than the average rate growth that we've seen the past few years.
I'm curious, how are you doing right now with regards to staffing and hiring, and more importantly, what you have to compensate those folks for?
It's market by market. Some markets are particularly difficult to hire in. We rely on terrific training and mentoring and developing from within our organization to help fill the important roles that we have to play. And then we are out recruiting the best talent we can find. We also rely on in some of our seasonal markets, whether it's a J1s or H-2B visas that help fulfill, especially ski resorts, the seasonality. So it's an important component, and that's something we have to stay very close to, and we're planning for next ski season now, so we have the staffing that we require.
You and me both. Alan, really appreciate your joining us today. Alan Fuerstman is CEO and founder of Montage International. We do have some more earnings crossing right now. Let's tell you about Discover Financial, which, of course, Capital One is looking to acquire. In terms of net interest margin, 11.2% versus 11%. EPS, $6.06 compares with $3.54 a year ago. And do we have an estimate? I don't even believe we have an analyst estimate because, again, this company is in the process of being acquired. There's less of a need to give its comparison to what analysts were looking for. Revenue net of interest expense, $4.54 billion. That is up 17% year over year. Coming up, we've got the top three, where we focus in on the top three movers and shakers at the center of the day's big stories. This is The Close. It's time now for the top three, where we name drop some of the people driving the day's most talked about stories. And first up is Georges Elledery. He will be the new CEO of HSBC starting September 2nd. His selection is a sign of the bank's deepening commitment to Asia because he speaks passable Mandarin, which will make him the first chief executive of HSBC, at least in its modern history, with this pretty critical language skill, given that HSBC gets half of its revenue from Asia.
Yeah, I was kind of surprised by that, given I've always kind of associated, I know it's technically European, but I've always kind of associated them with Asia for quite some time, with China specifically, so kind of curious that
it is
this is the
Hong
first
Kong
time.
and Shanghai Banking Corporation, after all.
But so it'll be interesting to see, like, what he can really bring to the table beyond just, having some mastery or at least some competence in the language, but also, of course, trying to get deals here. A person I've been keeping an eye on is a person we always keep an eye on, and that's Jamie Dimon, the CEO over at JP Morgan. An exclusive interview with Bloomberg Business Week with former President Donald Trump, and he was asked about what his cabinet would look like, and guess what? Guess whose name came up? Jamie Dimon as potential Secretary of the Treasury. We should point out, this isn't the first time Jamie Dimon's name has been speculated about. This came up, I think, when Biden was elected. Came up, I think, when Trump was elected the first time around. So it will keep coming up, obviously, a very seasoned banker.
Yeah, and of course, Trump's view on Jamie Dimon has changed because just last year he had attacked him on Truth Social as the highly overrated globalist Jamie Dimon. But Dimon had made some fairly favorable comments about Trump since.
Yeah, okay. Well, it'll be interesting to see, more importantly, I think, whether he he would even want that job. I mean, there's been a lot of speculation about his tenure at JP Morgan, which is basically long in the tooth. A lot of people saying he'll retire soon. So maybe if he wants to deal with a new administration, maybe this will be his exit.
He's also toyed with the idea of entering politics too. We just don't know what capacity, right? So that's always a possibility.
Okay, good
All
for
right.
him.
Lastly, Willow Bay and Bob Iger. They are our last slot. They
Which
are the
cabinet position are
LA
they
power
doing?
couple. No, not that cabinet. He's the Walt Disney CEO. She's the dean of USC's journalism school. They are taking over the Angel City Football Club, the city's women's soccer team. We don't know the financial terms of this deal, but it does value the team at $250 million, which makes Angel City the most valuable women's sports team.
Yeah, I was more surprised by that than anything else when we talk about just the value of women's sports. I mean, we remember we had interviewed maybe a couple years ago when Natalie Portman and some of the other people
One of the
there
co-founders.
were coming on to the program, and we were talking about how much growth you were going to see in this. And I guess if this deal is as reported, I think we have an answer.
Here's the payoff, right?
Yeah. All right, when we come back after the break, we're going to take a look back at F.W. Woolworth and the demise
blast from the past.
of the five and dime store. This is Bloomberg. All right, let's look back in history at the evolution of consumer spending and the devolution of what was once one of the largest retailers in the U.S. Because it was on this day, July 17th, 1997, when Woolworth Corp said it was closing its long unprofitable F.W. Woolworth retail chain, shuttering America's last major dime store. Now, the closure should have come as no surprise. After several years of slowing sales and several quarters of a slumping stock price, the retailer in March 1997 was pulled from the Dow Jones Industrial Average. It was a slow and sad fall from grace for a retailer that started all the way back in 1879, expanded rapidly across the U.S. and the U.K. in the 1900s, went public in 1912 and joined the Dow back in 1925. At one point, it was the largest department store chain in the world. But by the 1960s, F.W. Woolworth's quaint downtown stores had morphed from innovative to anachronistic amid the spawn of sprawling superstores such as Walmart and Kmart that offered more products, cheaper prices, and had lower overhead costs. Now, despite Woolworth's dominant footprint, the dime stores by the 1980s were at best marginally profitable, with most of its competitors abandoning the business model. Woolworth tried to adapt by leaning into its specialty brands and stores like Kinney Shoes, Richmond Brothers for men's clothing, and Champ Sports apparel. The specialty stores, for a while, were a lifesaver, but a clunky and costly rollout combined with shifting shopper behavior and an economic slump in the early 90s hastened the company's demise. And that brings us to our question of the day. Which publicly traded retailer today is a direct legacy of the Woolworth empire? The answer? Foot Locker. Woolworth launched the chain as a separate brand back in 1974, and after folding its F.W. Woolworth stores in 1997, decided to focus primarily on sporting goods, first renaming itself Venator Group before changing its name in 2001 to Foot Locker, which lives on today, operating roughly 2,700 primarily mall-based stores.
I would not have guessed that, Foot Locker and Woolworth, that lineage there, but you never know. Great stuff. Well, one of the top stories today, and certainly something that has been moving markets all around the world, is Bloomberg Business Week's reporting. We sat down with former President Trump in a Mar-a-Lago interview. It was an exclusive interview on the state of the U.S. economy and business, as well as his agenda for a potential second White House term. So for more on the discussion at hand, let's bring in John Micklethwaite. He's Bloomberg News' editor-in-chief, and John joins us now from the RNC in Milwaukee. John, it is so good to speak with you. This interview covered everything: taxes, interest rates, energy, immigration, tariffs. What surprised you the most about what former President Trump said?
I think there were some individual things that kind of cropped up. That bit where he casually said that Taiwan expected it to sort of pay for its own defense. I think in general, though, the pattern is of a president who is looking very much as sort of business as part of the kind of armory that he intends to use. And this repetitive sort of look about the need to take on China, I think he's definitely looking quite hard at the kind of protectionist side. And I think from a kind of global business point of view, it is a somewhat kind of mixed message. There are some parts of the Trump agenda, cutting taxes, going for burning up regulations, that business quite likes. But there are other bits like trade wars, which they're distinctly nervous about.
Yeah, the business's armory is a really good way of putting it. And I, too, was surprised by what he said about Taiwan. I think the people of Taiwan are surprised as well. One thing we've noticed, of course, is Silicon Valley increasingly turning out for Trump. Andreessen and Horowitz, because of his stance on crypto, Elon Musk, and before that, of course, Peter Thiel has been a big Trump supporter for years. Why do you think this is? Are they being pragmatic, knowing that bending the knee will pay off, or do they agree with his policy prescriptions, or they're just simply single issue voters?
I think the answer is, in each case, a bit of both. I do think there is a big sort of seismic change behind all this, which is something that is new. Is that until recently, the stance of Silicon Valley, the stance, Peter Thiel is a libertarian, the stance was that we can do all this stuff without government. We don't need government. Indeed, we epitomize the borderless world. We are the people who have the best products, and we're able to sell them everywhere. And what has happened around the world over the past 5, certainly 6, 7, 8 years, probably since the beginning of the first Trump presidency, is that business people around the world have discovered that not only is there a lot of jeopardy coming from government in the sense of regulation. If you run a big tech company at the moment, that's probably your main fear, is that you're going to get regulated in one way or another. But also there is a huge amount of money sitting there, which the government will spend. The government might protect you. It might move into things. So it has become entirely rational for people who previously used to say government doesn't matter to suddenly think government matters a lot. And that is, that's happened across many, many industries, but it's particularly noticeable in tech, I think.
I am curious, though, too, and it's interesting you talk about kind of the complexion of what this candidacy looks like and maybe what the next administration, Trump administration, looks like here. We talk about, I guess, some of the miscues and missteps that we saw overseas in your home country, over there in the United Kingdom. The experimentation with Boris Johnson, Liz Truss, and I think maybe 3 or 4 other people in between that I'm forgetting about. And we get to this idea here as to whether the U.S. is going down the same path that the U.K. went down, or is that parallel unfair to make?
No, in fact, I wrote a piece with Adrian Wooldridge earlier this week pointing that out. I think there is a distinct similarity between what the Republicans are doing and what the Conservatives did. And there is a question mark. The main question to me is whether they get bitten quite hard for this in 4 years' time, or whether it comes a bit earlier. And to explain, the Conservative movement, which I suppose I've written about for a long time, the American Conservative movement and the British Conservative movement have always marched in lockstep. And what's interesting is, on the whole, the British one has been just slightly ahead. You had Thatcher before Reagan, you had Brexit before Trump. You look at the complete implosion of the Tory party, and a large part of that, I think, was because they took some of the basic kind of conditions of being a Conservative, which are, you are somebody who evinces competence, you are someone who's managerialist, and you're someone who generally believes in a small state. And Boris Johnson and his heirs blew those things up. They came across as spectacularly incompetent. They spent more money. Everything went in different directions. And you look back at what happened to British conservatism, and there's a lot of people now thinking, what on earth did we do? And I think there could be a similar thing happening with Trumpian conservatism, because there are many things which Donald Trump is, but under most of the traditional ideas of being an American conservative, I don't think he really qualifies as that.
Well, I am curious, though, but just you sticking with the example of what went on with the Tories here, did that fail because the ideas themselves were bad, or was it the execution was basically the problem?
That's a very good question. The answer is a bit of both. I would say the execution was horrific, and that's partly to do with personalities. Is just as the Republicans, I think, are trusting Trump to fix things, on a whole host of different issues, the answer is Donald Trump will fix it rather than a particular kind of policy thing. The second, and that was very similar to the way that the Tories trusted Boris, somebody else who was known for chaos, I think. In Trump's case, it's a kind of, management by creating chaos has always been the way in which he's gone things forward. In Boris's case, it was more a kind of byproduct of incompetence. But I think underneath it, that yes, that there were some really big ideas that got them into trouble. And to give you one example, Brexit, what was happening was they were promising that completely different things to different groups of voters. So one group of people was saying Brexit is all about creating Singapore on the Thames. It's going to be a low regulation place. We're going to open up Britain to the global markets. Another group was saying to poor white voters, was saying, no, if we get to Brexit is all about protecting you. And you look at what the Republicans are doing here, there is some similarity. There's one group of business people who think the Republicans are great because they're going to cut taxes. But there's another group, white working class voters again, that the Republicans are saying, no, we're the people who are going to protect you. We're the party, we're the party that isn't going to shield you, not just from globalization, from free trade, but also from big business to some extent.
John, really appreciate your putting all of this into perspective. And it's an incredible opinion piece. I encourage you all to read it. It's at Bloomberg.com. John Micklethwaite is Bloomberg News' editor-in-chief. And by the way, that Donald Trump interview we were talking about, you can read the entire interview in the August edition of Bloomberg Business Week. Now, Trump has made it clear that he wants to double down on tax cuts if he wins a second term as president. That was in the Bloomberg Business Week interview. But in doing so, the muni market could be the loser, and that is today's muni moment. You remember the wide-ranging tax cuts that Congress passed in Trump's first term? The reductions for individuals were temporary and are set to expire next year. Now, Trump has promised to make them permanent, which is forcing lawmakers to hunt around for additional revenue. One area they're looking at is removing the muni tax exemption. Romaine, this is a 111-year-old exemption that enables state and local governments to borrow at lower rates because investors in muni debt don't pay taxes on the interest they earn. If you change this, that changes everything in terms of how city and local governments fund themselves, hospitals fund themselves, all of that.
Yeah, I'm a little confused as to where this is even coming from. And my guess is there'll be like a massive revolt around, not just amongst the investors, but obviously a lot of the municipalities themselves, because let's face it, without the tax exemption, there are a lot of municipalities that wouldn't be able to unload this debt the way they have.
It was actually a conservative think tank that floated the repeal of muni tax exemptions as a way to keep the Trump tax cuts permanent.
I understand that,
So it didn't come from nowhere, but it's one of those things that's kind of floating out there.
But it gets to what Micklethwaite was talking about, too, is about balance, right? You can have all these competing ideas, but if they start to be incompatible with each other, what's the thing? You have to kind of sync them up. And I don't know. It'll be interesting to see what happens, but this seems like a non-starter for a lot of those municipalities.
In the meantime, if you look at what happened in the markets today, politics is certainly moving things, especially if you look at the chip space, right? The Philadelphia Semiconductor Index, look at that, down almost 7% after the White House said it is considering tougher trade rules to hold back China's chip industry. You wonder how much of this is tied to President Biden kind of struggling a little bit and looking for something to get his voters excited.
Yeah, that was the big moves that we saw here earlier in the day. I just want to bring your attention to some after-hours movers, if we can here. Take a look at Beyond Meat here. The shares were down more than 20% at one point, now down about 12%. This on the back of a Wall Street Journal report saying that the company is looking to restructure its debt here. That's according to people familiar with the matter that the Wall Street Journal spoke to. Also, Leslie's down 17%. Now, this is a company that basically makes pool supplies, and we kind of use this as kind of a stand-in for consumer discretionary spending. Remember, Pool Corp a few weeks ago gave a big warning here about softness in that space here. And I think when you start to look for a canary in the coal mine about consumer spending, you see it from Leslie's, and to a certain extent, I think we even saw it from United today, where they talked about having to heavily discount their tickets in order to get people into the seats.
I'm so curious about that because I haven't seen these heavily discounted domestic fares that all these airlines are talking about.
This is like completely over my head. But it gets to the point that if they're saying that this is the second airline CEO in the last 2 weeks that has basically talked about discounting, so it must be a big thing, and we're going to get a few other airline earnings over the next 7 days.
This is The Close on Bloomberg.
All right, we're going to keep our attention on what's moving here in the post-market. We talked about Leslie's, Beyond, and United Airlines. We also got earnings out of Discover Financial, the company, of course, being absorbed by Capital One. Shares higher here in the post-market trade, with net interest income beating estimates in the most recent quarter. Joining us right now to talk a little bit more about this is Ben Elliott, Bloomberg Intelligence's analyst covering credit cards and mortgage lenders. And Ben, I want to talk a little bit here about exactly where the growth is for this company, particularly ahead of the big combination with Capital One.
So yeah, actually, there's not very much growth. Discover's kind of in an interesting spot. They're sort of managing to the close. And I think, as you can see from the aftermarket action there, they're doing quite well in investors' eyes. But the portfolio is relatively flat, and they're doing that sort of on purpose to kind of tone down potential opposition from Democratic regulators with a close around year end, which could get interesting depending on who's in the White House when the deal comes to its closing date.
Yeah, I'm curious about that, right? Because the DOJ could block this deal. It hasn't done anything yet on this front. And there's a lot of issues here that they're going to be considering, specifically whether Capital One's use of Discover's network will lead to increased interchange fees and whether that'll trickle down to consumers overall. What's your read on what regulators are looking at specifically?
Yeah, so I think if you look at it sort of objectively, the combination would be a very small player relative to Visa and MasterCard and Amex, and that should be pro-competitive. But obviously what is true and what is sort of politically expedient can be different at times. So you've seen sort of objection from certain lawmakers, mostly Democratic lawmakers, although some Republicans, who believe that combining these two card lenders would create sort of less competition and drive up some costs that consumers would pay. I think that we don't yet really know where regulators are going to come down on that. On Friday, the Fed and the OCC are having a public meeting where we start to sort of get a better sense of how regulators are thinking about it. But really the sort of boogeyman here is the DOJ, and we won't know until we hear more from them.
Just real quickly, I do want to just ask you a little bit about some of the credit loss provisions and charge-offs that we saw in the most recent quarter. I know for credit losses, that was down pretty significantly here, at least the provision that they set aside for that. Is that indicative of conditions, consumer conditions right now, or is this more tied to the potential merger?
You know, that's a big pre-sale play. They sold off their student loan portfolio, and they released the reserve associated with that. So that's a little bit of a tailwind, and it sort of also turns down the heat because obviously student loans are sort of the most politically contentious part of their portfolio. So we look at that as a positive ahead of the merger, and we think that's moving in the right direction.
All right, Ben, great stuff. Ben Elliott over at Bloomberg Intelligence. Discover shares up about 3.5%. We should point out Capital One shares also higher here in after hours trading by roughly 2% here on the day. A busy day here on the close, but we're not done yet. We're going to set you up for what to watch tomorrow. This is Bloomberg.
Asia's largest company, TSMC, is expected to report earnings on Thursday. In Asia, Charles Shi, an analyst at Needham in San Francisco, says the chipmaker likely to raise its full-year revenue outlook. Charles joins us now to discuss. And Charles, of course, TSMC last week did report better than expected revenue. So the numbers it'll give us tomorrow morning in Asia, is on its bottom line. Why do you see that leading to an increase in its outlook for revenue?
Well, I think it's for quite a while, they actually beat the high end of the guidance range. I mean, if you add what they report, the monthly numbers, April, May, and June together, they actually exceeded the high end of the quarterly guidance for Q2 by not a small margin. And into the second half of the year, you typically see a little bit of a seasonal uptick in terms of the smartphone, PC, etc., and that they are ramping their most advanced technology node called the 3 nanometer into the year, and they actually expanded triple the capacity from last year to this year. That's going to flow into the revenue in the second half. So we're expecting it's going to be a much stronger second half of the year. And when we look at the numbers, it only makes sense for them to actually raise the full year revenue outlook from what they call low to mid 20% of year-on-year growth from last year. It's probably going to land somewhere in the mid to high 20%.
You also say TSMC has latent pricing power that has yet to be exercised. Why hasn't it exercised it? And once it does, what do you anticipate the impact will be?
Yeah, you know, one of the things about TSMC is they basically charge everybody that's very similar price. The pricing is sort of actually transparent. The customer can be Apple, the chips going to your phones, can be NVIDIA, the chips that go into AI, chips going to data center. But, the value of those chips, going to your phone versus going into data center running AI is very different. If you look at a chip in your phone, it's probably $100-ish. But NVIDIA chips is like more like 20, 30K, but TSMC on a per wafer's the basic unit for their manufacturing is about the same on the same technology node. So which kind of makes TSMC like leaving a lot of money on the table in this AI semiconductor boom.
Yeah.
AI accounted probably single digit last year. So go ahead.
Well, I am curious though, then, how do you ramp up capacity in order to sort of take advantage of this, particularly before it sails by? I know there's been a lot of talk that they had, at least in the past, talked about increasing at least, so I think it was like 2 and 3 nanometer capacity, and maybe even 7 nanometer. How close are they to doing that?
They have actually been ramping capacity, quite aggressively through the last 3 or 4 years. Yeah, and you actually see there the overall capex, somewhere ranges of 36 billion a year. That has been going on for a long time. And then what took them by surprise was probably a big chip downturn starting in 2022 and extending into 23. But they built that capacity already. And you actually hear them talking about, we've done good amount of investment. We are going to harvest that investment. I think we're going to start to see that result going into the second half of the year and probably also going to next year.
All right, Charles, great stuff. Charles Shi, analyst over at Needham. A closer look at Taiwan Semi, which is expected to report earnings within the next few hours, of course, overnight out of Taiwan here. So could have some market moving potential here in the U.S. tomorrow as well. Let's take a look at some of the other items that we will be keeping an eye on that could be market moving. We mentioned TSMC. We also get, another major earnings report tomorrow after the bell.
Yeah, Netflix will be reporting, and of course, that's the gold standard for these streaming services companies. Netflix earnings kind of unofficially kicks off the earnings season for technology companies.
Yeah.
But really, it's about the streamers and how it's the dominant player in that space.
Yesterday, I asked you off air who would be the big Emmy winner.
Yeah,
and you said Shogun, and they got like
Shogun.
29, although the Bear got, I think, just as many, right?
I said Shogun and the Bear.
Shogun on the Bear. So Scarlett, definitely on top of that. We'll see if that affects Netflix. All right, let's get to the boring stuff. An ECB meeting, Scarlett. 8:15.
Boring? What are you talking about?
8:15 a.m. New York time.
And
Christine
then
Lagarde
30
there.
minutes later, Christine Lagarde holds her news conference. Not boring at all.
8:30 a.m. We're going to get jobless claims numbers here in the U.S. We're also going to get Philly Fed data, as well as those leading economic indicators at 10 a.m. And I'll leave this for you. Fed speak. Who you got?
We've got Logan. We've got Daly. We've got Bowman. They've got just 2 more precious days before they're in media blackout mode.
And of course, we are keeping an eye on the Republican National Convention. The highlight of that convention will be on Thursday night, where we do get the acceptance speech from the presumptive nominee, Donald Trump. Full politics coverage coming up next on Balance of Power. Stick with us. This is Bloomberg.